Mark, I keep reading that in an interest rate tightening cycle, this isn't good for gold because gold doesn't pay a coupon, gold doesn't pay dividends like stocks and bonds. But you say when interest rates rise, that's actually a positive for gold. Can you explain?
Yeah, absolutely. It's like a lot of narratives out there, and received wisdom can sometimes be incorrect. And the received wisdom is, the narrative is that rising interest rates are bearish for gold. But if you look at the data, you look at the charts, as you guys in Bloomberg are wonderful at providing that data and charts, you can clearly see the most recent example of rising interest rates was from 2003 to 2006. During that period, from June 2003, the Fed funds rate was at just over 1%. It rose to over 5% by June 2006. So it went up more than 400 basis points. And what did gold do in that environment? And I remember the company was set up in 2003, and I remember the narrative of the banks at the time was exactly that rising interest rates would be bearish for gold. What actually happened was gold prices rose. So they went from $350 in 2003 to $650 in June 2006. So they went up more than 80% in a rising interest rate environment. So that right there, it disproves the received wisdom and the narrative that automatically gold prices will fall in a rising interest rate environment. That's not to say that they may, but it is very simplistic and extreme to say automatically rising interest rates are bearish for gold. That is not the case. And there's a second example is actually the 1970s when Sorry, I interrupted you.
So no, carry on. Tell us about the 70s, Mark.
Yes, so from 1971, the Fed funds rate was below 5%, and by 1980, obviously, there's a period of inflation and stagflation in the 1970s. By 1980, the Fed funds rate was over 18%, and the gold price went up from $35 to over $850 by 1980. So it went up 2,400% in a period of rising interest rates. So again, that questions the narrative. What's bearish for gold is actually positive real interest rates. So it's only when you have, and the savers out there who are being punished at the moment, and people who own bonds, when they get a real return on their assets, that's what's very bearish for gold, as was seen in the late 1970s. And I think, it's only towards the end of an interest rate tightening cycle that I think gold will be vulnerable to further falls. But with gold down 40% from the highs, it's hard to know, will it go much lower, particularly given the cost of production and also the very significant demand that we're seeing, particularly out of China and India.
Hey, Mark, we noted earlier that we see gold rising today as stocks rally. Typically, gold and stocks are inversely correlated, but I can see if I look at a Bloomberg HS screen that inverse correlation has been weakening lately. How important is this kind of inverse correlation?
Well, it's interesting, Matt. You're dead right. Sometimes gold can be correlated with equities in the short term, and we saw that in 2008 when significant volatility, sharp falls in stock markets around the Lehman Brothers event. Gold prices actually fell in unison with stocks, so there can actually be a correlation with stocks in the short term. But over a quarterly and annual basis, there tends to be an inverse correlation. So we were actually surprised how well gold held up in the last 3 weeks. We thought we might see what tends to happen is gold falls as well. It falls slightly less than stocks in a period of falling stock markets, and then it tends to outperform over the medium and long term. So the fact that gold is up 4.5%, nearly 5% year to date, whilst most leading indices are down 7%. I think the S&P is down around 6%, 6.5%. It's quite bullish. It makes us quite positive on the year. We were concerned coming into the year that we could see weakness in the short term, but we are quite constructive in the price in the medium and long term.
Does it matter if stocks recover here? I mean, the last time we had a start to the year this week for equities was 2009. Of course, that year ended up with a 23.5% gain in equities. If we had a recovery with stocks here, does that bode well or poorly for gold?
Most likely poorly, but again, we don't have the crystal ball in the short term, and I suppose rather than focusing on the price and trying to predict what it might do in the short term, I think most analysts are actually nervous in the short term. The sentiment is beginning to change. There are some people who are increasingly bullish in the short term, but most analysts are bearish in the short term and bullish over a 3-5 year period, and that's how we would be. But more importantly, as you said, it's that inverse correlation, but with stocks and bonds. I mean, if you own a portfolio, investment portfolio, or pension portfolio, all the research shows that an allocation of, traditionally the allocation was 5 to 10% was always the allocation that you would have to gold as both a hedging instrument and a safe haven asset. There is increasing research showing that you could go as high as 20 to 30% in gold, given the fact that bonds are at all-time record highs and yields are at all-time record lows. There is a merit in the argument that you could have higher allocations to gold. So, and that's what we're advising clients at the moment. And we've seen, obviously, you see it in the ETF holdings, there is quite an increase, and we're seeing that as well in terms of demand. It's probably the best start for a year that we've had in many a long year, you know, because in the last few years people haven't needed gold because stocks and bonds have performed so well.
And Mark, rather than talking about gold as a haven, let's chat about the fundamentals. What does demand from the likes of China, India, what's central bank demand telling us right now?
Well, I mean, it's very, very strong. We're near record highs from both China and India, and central banks are net buyers again, and both the Russian central bank and the People's Bank of China are some of the biggest net buyers in the world, and they're buying roughly 15, 20, 25 tons every single month. You know, they're sort of dollar cost averaging, and they're just doing what most people do. They're rebalancing their portfolio. You know, they are a little bit overweight various currencies, including the dollar, and they're sort of diversifying into gold over a period of time. So that seems to be a pillar of support underneath the gold market. The Chinese demand is interesting. It's I mean, very, very high. We're at a run rate of roughly 50 metric tons per week on the Shanghai Gold Exchange, and you would think, given the scale of the crisis in China, that may increase. You know, and the Chinese, gold is a huge part of their culture. It's a big part of their psyche. They do tend to save in gold. They don't see it as a speculative commodity. They do see it more as a form of money. So it may, who knows? No one has crystal ball. It may fall, it may rise, Chinese demand, but we do believe there is quite a floor under the price, and the level of demand we've seen in recent years is likely to continue.
Mark, really quickly, and I mean really quickly, what's the best way of buying into gold? What do you recommend?
Well, we sell physical gold, so we would say that, but we do genuinely believe that if you are buying gold as a hedging instrument and a safe haven asset, the safest way to own it is actual physical coins and bars in the safest vaults in the world. Zurich is probably, once again, one of the favourite destinations where we're storing gold on behalf of clients. ETF is great, but it's more short-term, taking a punt on price over a short to medium term. It's not really a store of value over the long term.